Ladies and gentlemen, good day and welcome to SG Finserve Limited 2Q FY26 earning call, hosted by Motilal Oswal Financial Service Limited. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Raghav Khemani from Motilal Oswal Financial Service. Thank you, and over to you, Mr. Khemani.
Yes, thank you. Good afternoon, everyone. I am Raghav Khemani from Motilal Oswal, and it is our pleasure to welcome you all to this earnings call. Thank you very much for joining us for the SG Finserve call to discuss the Q2 FY26 earnings. To discuss the company's earnings, I am pleased to welcome Mr. Saurabh Dhawan, Chief Executive Officer, Mr. Sahil Sikka, Chief Operating Officer and Chief Financial Officer, and Mr. Anubhav Gupta, Group Chief Strategy Officer. We will have the opening remarks from the management, followed by Q&A. On behalf of Motilal Oswal, we thank the senior management team of SG Finserve for giving us this opportunity to host you today. I now invite Mr. Anubhav Gupta, Group Chief Strategy Officer, to take the proceedings forward. Thank you, and over to you, sir.
Thanks, Raghav, and thanks to Motilal Oswal for hosting SG Finserve for its Q2 FY26 earnings call. Good afternoon, everyone. I welcome each one of you on behalf of SG Finserve to listen to our Q2 FY26 earnings call. As the opening remarks, I would like to highlight two things. One is the performance for the company in the Q2 and first half of FY26. The change in the management which we are having, and thirdly, I would like to welcome Mr. Vinay Gupta as the new CEO of SG Finserve, who would join in month of November, and Mr. Deepak Goyal, who joined as the Independent Director and Non-Executive Director in SG Finserve. Now, coming to the Q2 and first half FY26 performance, glad to share that the loan book grew by 15% on quarter basis in Q2 to around 2,878 crore rupees, which led to 14% increase in PBT and 16% increase in the net profit. Going forward, we believe that 10% quarter-on-quarter earnings growth is feasible, given the current loan book what we have and the new accounts which we are opening. On the management change, I would like to highlight that Saurabh, the current CEO, and Sahil, the current CFO and COO, they have been with us since we started the company. We wish them best of luck as they decided to move on. At the same time, we have ensured that there is a very smooth transition which is taking place, which will not impact or disrupt business operations in any way. And with all of our best wishes are with Saurabh and Sahil. Secondly, we are also ensuring that the quality of loan book also remains top A class. So far, we have disbursed 52,000 crores since we started the company 36 months ago. And there has been zero NPA. I'm again repeating, zero NPA, and the focus of existing management, new management, the board will always remain to be zero NPA because of the quality of loan book what we chase for, and the type of accounts what we are adding. The quality accounts, the corporate accounts, which are India's top 50 corporates, and they are going to be our anchor customers as always. So the risk will always be very minimal as we grow the business from 2,800 crore loan book to 5,000 crore loan book in next 2 to 3 years. In short to medium term also, the clients, how they are growing their businesses and we are funding the receivables, we are confident that quarter-on-quarter earnings growth should be 10% on QoQ basis. And when the company gets fresh equity in March, April of 2026 from the warrant conversion, we shall go slightly aggressive in expanding the loan book, but with the mindset that whatever comes on our table, it has to have minimal or almost zero risk. That's all from my side. Now Saurabh will take you all in detail about the Q2 performance.
Thank you, Anubhav. Good afternoon, everyone, and thank you for joining us for the Q2 FY26 investor call of SG Finserve Limited. It gives me immense pride to share the continued momentum we've built across our business and strong results we've achieved in the first half of FY26. Over the past few years, SG Finserve has certainly evolved from a young NBFC into a key player in MSME supply chain financing, powering over 1,000 plus MSMEs and facilitating disbursements of over 52,000 crores. Our loan book has now grown to 2,878 crores as of September 2025, reflecting a 15% increase over the previous quarter, along with a similar increase of 16% quarter-on-quarter growth in profitability. We continue to maintain zero NPAs, reaffirming our robustness of our business model, the strength of our anchor partnerships, and the trust we have earned across our ecosystem. Our focus remains clear to expand our reach digitally, deepen relationships with existing anchors, and onboard new industry leaders who share our commitment to building a resilient and inclusive supply chain ecosystem. With a strong equity base of 1071 crores and additional equity of 338 crores expected by April 26, we are well positioned to achieve the target AUM of 6,000 crores by FY27. As we continue this journey of growth, I would like to share some organizational updates. After a rewarding and fulfilling journey with SG Finserve, building it from the ground up, I have decided to pursue a new corporate opportunity. It has been an incredible privilege to lead this organization, nurture it since inception, and work alongside a talented team that has built SG Finserve into one of India's most trusted names in supply chain finance. I continue to believe that supply chain finance will remain one of the most powerful enablers of India's growth story, empowering MSMEs and strengthening the nation's industrial backbone. To take this belief forward on a larger canvas, I have chosen to embark on a new professional chapter. I am delighted to share that Vinay Gupta, chartered accountant and a seasoned banker with over 20 years of experience, will take over the baton as CEO. I wish him and the leadership team the very best in achieving the vision we have collectively envisaged for SG Finserve over the coming years. There is another change in the leadership team, wherein Sahil Sikka, Chief Operating Officer and Chief Financial Officer, who has been instrumental in shaping our business and financial strategy, has decided to move out and pursue another career opportunity. Sanjay Rajput, who's been part of our journey as Head of Finance and Accounts for the last 2 years, will now take over as Chief Financial Officer, bringing with him over 18 years of rich experience in finance and accounting across leading institutions. Additionally, Saurabh Mishra has been appointed as Head of Internal Audit. He is a chartered accountant with prior experience of working with Grant Thornton, that is to further strengthen our governance and risk oversight framework. I have complete confidence that under this strengthened leadership team, SG Finserve will continue to build on its strong foundation, deliver sustainable growth, and create long-term value for all stakeholders. I thank you, each one of you, for the continued trust and support. And we are open for questions now. Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use headset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Mr. Rehan Syed from Trinithr Asset Managers. Please go ahead.
Yeah, good afternoon, and thank you for giving me the opportunity. So my first question is on the loan book side. So your substantial loan book growth remains healthy in quarter two. So how do you see the momentum sustaining over the next couple of quarters? And are there any capacity or capital constraints that you could moderate growth? And just continue with the first question. My second question is on the operating leverage side. With scale benefits kicking in, do you expect any operating leverage to improve meaningfully in the second half? How should we think about the cost to income ratio trajectory going forward? This is my first question.
Thank you. Our next question is from the line of Rajesh Jain from RK Capital. Please go ahead.
Yeah, thanks for the opportunity. So I wanted to ask that the management had guided for 250 crore of profits for the financial year 27. I just want to clarify whether that is the full year PAT or that is the exit run rate that the management is referring to.
So that is the PBT, not PAT. It's profit before tax. And given the current business in hand, we are confident that 250 crore PBT can be achieved for FY27.
So that is the full year PBT you're targeting, or that is the exit run rate, basically?
It should be full year.
Okay. And in your recent business update, you have published some average loan book figures. So is the average taken basis the daily loan book? Is it the average of the daily loan book?
Rajesh, it is taken basis the daily loan book.
Okay, thank you. And
actual average. It's not opening closing. It's actual average computed on daily basis.
Yeah. That helps you. And what will be the ESOP expenses per quarter for the rest of the 2 quarters?
So it's about 2 crores per quarter.
Okay.
With 2 exits, it's expected to reduce. So we can, for next 2 quarters, we can take it at about 1.6 per quarter.
Okay. Fine, I'll get back in the queue. Yeah, thank you.
Thanks.
Thank you, sir. Our next question is from Ram Tawa from Equinix Capital. Please go ahead.
Yeah, can you all hear me?
Yeah, please go ahead.
Yeah. Okay. So the earlier guidance given for this financial year ending the PAT will be around 150 crores, and for the H1 26 we have achieved around 53 crores PAT. So are you still confident that close to that 100 crore increment will be there in the next 6 months when it comes to the PAT?
Can you repeat again?
So the earlier guidance in the last earnings call, you said for this financial year, the PAT would be 150 CR, around 150 to 160 CR, right? That's the guidance given. But for this 6 months, the first half of financial year, 53 CR is the PAT we have achieved. There is another 100 crore to go in the next 6 months. We have to achieve that 150 to 160 crore PAT PAT after tax. So are we still confident about that 150 CR, or is there any revision to that PAT achieved?
Yeah, so what we believe is that 10 to 12% quarter-on-quarter EPS growth in Q3 and Q4 is possible. Okay, so we should be near about 120-125 crore of PAT, which is slightly lower than what was earlier guided, 150 crore for the full year. This, of course, is in the backdrop of slowing macro environment in the country, where the businesses have not grown as expected. So all our customers, whether in building material sector, in metal sector, in auto sector, in FMCG sector, in electronic sector, even they have trimmed their revenue guidance for full year. So that has also impacted supply chain funding where we operate. And in the current environment, we don't want to be too adventurous, wherein there is even an iota of possibility for any NPA. So we are slightly cautious in current environment. So yes, there will be slightly the actual performance will be slightly lower than what was earlier expected at the start of the year. But if things improve better than expected in terms of macro, everyone is expecting that economy should start doing better from November onwards. So there could be slightly positive surprise, but yes, what investors should build in 10 to 15% quarter-on-quarter growth in EPS for Q3 and Q4.
Good. And the second question is, there's a warranty conversion of close to 500 crore this year, right?
Yeah. So 25% had already come, right? And the balance 338 crore will come in April 2026.
Does that lead to any equity dilution? Number of shares will be increased?
Around 1 crore.
1 crore.
1 crore.
1 crore share. Okay. And then from our company side, multiple times we asked this query to the investor relations, but we didn't get any response. So probably maybe a suggestion from your side that investor relations should be active on responding to this point.
Feedback well noted. We'll take care of that.
Thank you. That's all from me.
Thank you, sir. Our next is from the Rehan Sayyed, Trinity Asset Managers. Please go ahead.
Yeah. Hello. Am I audible now?
Yes, Rehan, you are audible. I think you'd asked a question, but we missed answering, right?
Yeah. So just I am continuing my first question. I think you have answered my first question, so I am continuing with the second one. So sir, this is on the operating leverage side and cost efficiency. So within the scale benefits kicking in, do you expect any operating leverage to improve meaningfully in the second half? And so how should we think about the cost to income ratio trajectory going forward in the next 2 to 3 years?
The cost to income, as we said, that the vision is to grow digitally. The cost to income will always remain on the lower side. The major costs which are in the leadership team and middle management, the same shall continue to be at similar levels only. And what we need to do is put some physical presence in place, which is not that expensive. The cost to income ratio from about 70 basis points is expected to come down to 60 and then probably 55 basis points over next 2 financial years.
Okay. And then, on my last question is, I want just more clarification on the industry-wide. So, with multiple NBFCs and fintechs entering supply chain finance, so are you observing any yield compression or competitive intensity in sourcing quality anchor programs here?
And we believe that, as I mentioned in my words also, that supply chain finance is here to grow. It is not only the existing piece of business, it is also the transition from the CC overdraft facilities, which is happening into more controlled end-use backed limits. So the industry is extremely large, and I think there is space, much and more space for everybody to exist and grow.
Okay. Thank you for your clarification, and I'll be talking it again.
Thank you.
Thank you, sir. Our next line is from Ronil Dalal from Fincom Family Office. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good set of numbers. It's Fincom Family Office. So just my first question is that I just wanted to know what was the reason for Prince Kumar Shukla's resignation as internal auditor, and if you can share some more thoughts around the appointment of Mr. Saurabh Mishra in his place.
So So Prince has been with us for almost 2 years now, and he was always part of finance and accounts team. While we needed an internal head of internal audit, we had appointed him. Plus, we also have EY as a full-time consultant supporting us on head of internal audit. So now we have found a more appropriate person who can manage internal audit and value add, and that is the reason that we've appointed Saurav Mishra. The head of internal audit, Prince, was appointed only in the month of March or April. So it was very recent only. He's been there only for 6 months as head of internal audit, and we found Saurav Mishra to be more appropriate. That is why he's been appointed.
Right. Just because, I think there are a lot of changes altogether. I think even the company secretary is new. Mr. Kush Mishra, any relation to Saurav Mishra?
No, there is no relation. And Kush has been with us since last quarter. So he joined us in the month of September. The earlier company secretary had left end of September, and he was there. He was already there with us as a compliance officer and appointed as a company secretary in the current board meeting.
Sure. Thanks. The next was that just the cost of fund, is there any scope for a cost of fund reduction? Last quarter, we were around 8.25%. So with the interest rate cycle cut, when are we expecting cost of funds to get repriced?
Vis-a-vis last quarter, we have substantially reduced our cost of funds. Currently, we have 15 banks on board, banks and financial institutions on board with us. And the reduction in cost of funds is an ongoing exercise wherein the treasury team keeps on discussing this is the current market conditions. And we further envisage, and it is a constant endeavor from our side also to reduce the cost of funds. So quarter on quarter, they will keep on reducing. However, putting a definite number on the same will not be possible. But there will, yes, definitely be an improvement in cost of funds going forward as well.
Sure. Would that be in the next few quarters, or you mean maybe more longer term, in a year or so?
So it's an ongoing process. Quarter on quarter, there will be an improvement.
Sure. Okay. Thank you so much. Thanks.
Just for record purpose, I would like to reiterate that we had guided for 200 crore of PBT for FY26. That means PAT of around 150 crore, which was our guidance, and now we are saying around 120 and 125 crore somewhere it should come. You can go ahead.
Hello, am I audible?
Yes, we are there. Yes.
Yeah. Thank you for the opportunity. So I wanted to ask, what is the reason for why are we seeing such a sharp reduction in our yield from 12.4% in Q1 to 11.5% in Q2? Are we facing any competitive pressures, or what is the reason for it?
So it's a strategic move as we got two large anchors, which is Tata Motors, Mahindra and Mahindra, and Tata Steel, where the yields are little on the lower side to begin with, and we strategically entered those, which is in the range of about 11%, and we expect once we are able to penetrate, we'll be able to improve yields from here, and that is the reason that the overall yield has reduced a little bit.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Tushar Verma from Big Shot Trading. Please go ahead.
Am I audible?
Yes, Tushar, please go ahead.
Yes, well, doctor. So my question is on this multiple top management changes recently. The CEO, CFO, CEO, all resign on the same day. So could you please explain the reason behind this? Was this coordinated or coincidental, and how the company plans to ensure smooth continuity going forward?
So Tushar, this is not coordinated. It is a coincidence that we've decided to move on the same day, but the transition is already planned. As we've already mentioned that Vinay, who's joining us from Yes Bank, holds about 20 years plus of experience in supply chain finance and trade finance, and he will join in. And similarly, Sanjay, who's been with us for past 2 years and heading finance and accounts, he takes over as Chief Financial Officer. The transition is extremely smooth and everything will be is very well taken care. So we also want the company to progress well over the years. It has been built from scratch by us, and that is the reason the transition has been kept smooth. And we will still continue to help in the handovers, takeovers, etc. over the next few days.
Tushar, just to add to this, we appointed Saurabh and Sahil. We knew them for many years as they were in Kotak and HDFC banks respectively, and they were handling APL Apollo account also, right? So the relationship wasn't new just because of Finserve, but it has been there since APL Apollo used to take bank limits, etc. And so is Vinay Gupta, who is coming from Yes Bank. He has been handling our account for a very long time. So our idea is also to appoint hire people to run NBFC business because as a group we are new here, right? And we want to work with people whom we know for many years, and collectively we can create a good business model. Over and above, we have Mr. Deepak Goyal also, who is serving as a group CFO. He has been appointed as a non-executive director, so that he also has who can keep an eye continuously. So we are fairly confident that there is not going to be any kind of disruption. The business will run as usual, and we are implementing all possible business continuity plans.
Okay, sir. Okay. Thank you for such a detailed clarification. Thank you so much.
Thank you, sir. The next question is from the Darshan Patel from Money Works for Me. Please go ahead.
Hello, am I audible?
Yes, Darshan, please go ahead.
Okay, so I just have one question. So, does our competitors have similar level of NPA in supply chain segment?
The NPA levels across supply chain financing are lower in comparison to other vanilla financing. Answer is yes. But do they have nil NPAs? Answer is no. And we also might have some NPAs going forward next few years. But in comparison, supply chain finance is a much safer financing compared to other term lending or personal loan or business loan products.
Okay. Thank you so much.
Thank you.
Thank you, sir. The next question is from Amitav Vatse from Southern Venture. Please go ahead.
Thank you for taking my question. I have two questions. One is, what is our guidance and what is our internal target as an organization for?
No, say it again, please.
Yeah. Sorry, Amitav, we missed your question.
So give us a moment, please.
Sure.
Mr. Vatse, please repeat your question.
My question is that currently I can see the return on equity is around 9%. So what are the target? What we have set as a target for increasing it to any digit we are specifically trying to reach? What is our goal post in terms of return on equity?
Above 15% first milestone, and then take it to 18-19% eventually.
So eventually, what is our strategy for reaching to 15% from 9% current level, which we can see?
So leverage, right now the leverage is around 1:2, right? And we'll like to take it to 1:3. As we do that, going forward, ROE shall improve.
Okay. In terms of yield or NIM, what we are looking at comfortably, what we can achieve as a NIM?
Between 12 to 13%.
Okay. And that is in line with what we have achieved so far? Or are we going to see some expansion in NIM?
Definitely, there will be some expansion because at the distributor levels of large brands, now we are targeting retailers under the distributors. So we have already pilot launched with some anchors, and as that program starts performing well, the NIMs will definitely expand by 50 to 100 bips.
Okay. So it is more on we will be able to price our product at a higher rate than the peer. I mean, is it due to the cost reduction or is it due to the expansion in the yield?
No, expansion in the yield, because within the current ecosystem where we are funding a distributor of a brand A, now we will go one tier below, where we will start funding the retailers of that distributor. Right, keeping his skin in the game. So once we start lending to retailers, the NIMs will expand by 200-300 bips, and on average book, our NIMs can go up by 100 bips, 150 bips.
Okay. So will this stopgap arrangement will be valid for the level 2 also?
That is right.
Okay. So I have just another one question. With respect to the sector-wise exposure which you have, if you can share what is our structure in terms of exposure-wise, whether we are exposed to infrastructure and real estate and building material and auto. So if you can give us a bifurcation of sector-wise.
So we probably are present in 3 widespread industries. Number 1, building material. Within building material, we are well diversified in terms of various sectors, such as we recently tied up with Saint-Gobain. So glass, tiles, metals, commodity, etc. Then number 2 for us on a larger industry comes automobile segment, wherein we have tie-ups with Tata Motors on the commercial side, then on the passenger vehicle side, JSW Motors, then Ashok Leyland, etc. Then third comes the IT and peripherals, in which also we are diversified in terms of the mobile segment, tie-up with Oppo, then the IT, other IT equipment or other equipment such as with Redington, Ingram, etc. So well diversified in terms of industry, and there is probably no concentration in any one segment as such.
Okay. But we have, if we can get some percentage numbers, like we can, if you have any ballpark number, like 30, 40%.
On the percentage side, since we started our business with tie-up with APL Apollo Tubes, so that holds the larger share in our business, but that is also gradually reducing as we are as the other anchors are growing up their scale in our business. So APL share or the
building material share would be 50 to 60%. Then auto would be 20%, and IT and peripherals will be 20%.
Okay.
60, 20, 20. Building material 60, 20 IT peripherals, and 20% auto.
Okay. Thank you.
Thank you, sir. The next question is from the line of Varun Gajaria from Omkara Capital. Please go ahead.
Hi, sir. Thank you for taking my question. I understand that this is slightly the first time, covering this company. So just would like to get something very basic clear here. So basically, we want to expand our book from currently 2,800 to around 6,000 crores, right, by 27. So while we do that, and the recent you said that we took some cut on our yields. So we'll be looking to onboard new clients going forward. So how do you look at the yields going forward? I'm sorry if you have already mentioned this before. I just wanted to get some clarity on the same. Would it still be that you'd have to take little bit of discount to attract clients? How would it work?
I think strategically we've taken discount for two major anchors, which I mentioned were Tata Motors and Mahindra. I don't think we foresee taking any such discount anymore. This time the yield is close to about 12%. We expect to increase it to steady state should be about 12.25 to 12.45%.
Okay. Thank you so much.
Thank you.
Thank you, sir. The next question is from the Yashaj Mehta from Ionic Asset. Please go ahead. Mr. Mehta. Mr. Mehta, please proceed ahead with the question.
Hello, am I audible?
Yes, you are audible. Please go ahead.
We trimmed it down to again 125. What really I wanted to understand was over the last couple of months, because couple of months is when we were talking about 150 crores of PAT for the year. What has exactly changed? And the reason for us to actually aim for a lower PAT now. Is it a conscious decision to kind of safeguard asset quality that we've kind of decided to take it slow? And secondly, wanted to understand what would be our strategy to achieve our FY27 guidance going forward. Is it that we are looking to empanel aggressively and get into new sectors? Just wanted to understand the strategy part, and also what has changed in the last couple of months that we've been constantly reducing our guidance.
So there are two things, right, for the reduction in guidance. One is the overall macro slowdown, right, which every sector is witnessing, whether it is construction material, whether it is auto. If we remove last 1 month kind of sales, we know how auto sector performed in the first 6 months, right? And so is the overall consumer discretionary, which is linked to the IT and peripherals of what we do, correct? And like I said, you can dig out the data of all the anchors what we have as our customers. Many of them are listed, and the way they have reduced their own revenue guidance, right? Similarly, as a supply chain financer, we also need to take business hit, right? Now, the one way to compensate is that we become adventurous, right? And we try to add tier 2, tier 3 customers where we could add or we could expand our loan book. But consciously, we decided not to do that, correct? So we are confident that once there is revival in the economy, right, business will come on its own. We are already empaneled thick with our customers, right? Our tech stack is deeply empaneled in our customers' systems. Our teams are deeply related to all the relevant teams at our customer end. So we are very much confident that once there is overall economic uptake, right, once our key anchors they start seeing a double-digit volume and revenue growth, SG Finserve will also get business at high speed, and whatever we lost in the first 6 months, we will make up for that. Not maybe within FY26, but FY27 could be better than what we are guiding for. And coming to FY27 expectations, we have a lot of anchors whom we are talking to bring on board. The new management shall also bring its own relationship, which will add to the business. and hopefully the economy would be performing much better in FY27 than what it has done in last 2 years. So this gives us confidence that we should be able to achieve numbers what we are envisaging as of now.
First question, just wanted to again get a hang of the numbers that we've spoken about. So 125 crores of PAT for this year. What is the exit AUM that we're speaking about? And again, for FY27, we are talking about 250 crores of PBT. And what is the exact exit and the average AUM that we are looking at?
So the exit...
or the average loan, yeah.
Yeah, so the exit PAT for Q4 should be around 35 crore plus minus, okay, which was 28-29 crore in Q3. In Q2, it should be around 35 crore plus minus in quarter 4. And then for FY27 to achieve 240-50 crore of PBT, that means a PAT of around 190 crores, right? So we should be around exit rate should be around 45 crore of PAT, 50 crore of PAT, the exit rate in Q4 FY27.
And the loan book that we're talking about FY27 and 26? Hello? Am I audible?
Yeah.
So you are on mute.
Yeah. So the exit loan book for FY26 should be around 3,500 crores. Okay. And
FY27?
And FY27 should be around 6,000 crores.
Okay.
And
That answers my question. Thank you.
yeah, there could be positive surprise in FY26 loan book if economy does better in last 3 months, which it normally does. We could surpass 3,500 crores and we could hit 4,000 also. But that depends on how economy would perform. But 3,500 is what we are fairly confident.
Got it, sir. Thank you so much and best of luck.
Thank you, sir. The next question is from the line of Jay Prakash from Corman Capital. Please proceed ahead.
Yeah. Sir, just question on what are the target areas? Currently, I see that you're targeting 3 areas largely. So if you can just size up the industry for us and what could be the target areas, that's the first question. And the second question is can you elaborate what is the reason you mentioned that the supply chain is gaining traction over the CC and overdraft? So if you can talk about the benefits, what is it driving that growth? Thank you.
Hi, Jay Prakash. So I'll answer the second question first. Overdraft and cash credit facilities are open-ended in nature, where banks are not able to control the end use of funds. The funds can be deployed in any manner. On the other side, when it comes to supply chain financing, when we say that we have disbursed about 52,000 crores through our counter until now, this ensured that every penny directly went to the anchor's account and anchor supplied material to the dealer. So the end use of funds of every penny which got disbursed from our counters was ensured. And that is the reason that entire industry, banks, financial institutions, etc., everybody is focusing on supply chain finance. And we have started to see number of balance sheets wherein cash credit and OD facilities are going down and supply chain financing limits are increasing. So that is the reason of this transition. On the target areas, supply chain financing continues to be our focus product, and industry-wide, the choice of anchor is extremely important, and we make sure that whichever anchor we onboard, that has to be an industry leader, and whatever the names that you will look at which are working with us, they all are leaders in their respective products. Because what sells off the shelf, the money comes on its own. Otherwise, you have to go and collect. So that is the motto that we've always believed in. Thank you so much.
Thank you.
And on the first question, okay, so yeah, sorry. Next, please.
Thank you, sir. Our next question is from Krish Kothari from K Kothari. Please proceed ahead.
Hi, my questions have been answered. Thanks. Hello.
Yeah, please proceed.
No, my questions have been answered. Thanks.
Yeah.
Thank you, sir. The next question is from the line of Rajesh Jain from RK Capital. Please proceed ahead.
Yeah, thanks for the follow-up. Sir, I have one request and one question. Okay, so I'll just articulate my request first. So regarding the financial year 26 guidance of 150-160 crore, we are getting different answers at different times. Okay, so today in the call you have said that the guidance was revised downwards to 120-25 crore due to economic slowdown. Okay, but just a few weeks ago during the Bharat Connect conference organized by Arihant Capital, so Mr. Saurabh Dhawan had told that 150-160 crore was never the guidance. It was the exit run rate. Okay. So I'll request the new incoming management to be very specific on guidance. 50% growth is also a very good guidance. But if you say 100% and deliver 50%, it gives wrong impression to the investors. So that's the feedback and that's the request. That's the feedback to the outgoing management and that's the request to the incoming management. And my question is, I just wanted to understand that apart from your supply chain finance, which you have articulated at various times in various calls, you had briefly hinted during the Bharat Connect conference that you had in the past done some vendor financing also. Okay, so can you explain that vendor finance model? What do you exactly do in that? How does it work? Can you just explain that part?
The vendor financing is a product which is basically done for mid-corporate customers, which are in the range of 1,000 to 2,500 crore turnovers, wherein we give money to their suppliers, wherein we give money in advance to the suppliers. These mid-corporate customers are able to avail discount, and then these mid-corporate customers can pay us back in 60 to 90 days time. So that is how this product operates. We had created a loan book of close to about 200 crores, which is almost negligible today. So this book we had closed down because the exposures required here were in the range of 25 to 30 crore plus, which we did not feel comfortable and we exited that. So focus has been on dealer financing since then.
So going forward, you are not going to do any vendor finance going forward?
As of now, we are not doing, and as of now, we are not doing any vendor financing.
Okay, but still for the sake of clarity, I did not understand. So you said you are supplying this finance to the suppliers of mid corporates. That's what you said, right?
Yes.
Okay. All right. Okay. Yeah. Thank you.
Thank you so much.
Thank you, sir. The next question is from the line of Vandit Jain from Stake One Investment. Please proceed ahead.
Yeah. Am I audible?
Yes, sir, you are.
Yeah. You briefly mentioned about moving down a step to retailers, so the distributors and their retailers financing those. So could you just spend a little more detail on how that will work? And for distributors, you've mentioned in previous calls that we have a stop supply arrangement with the anchor. So would we have something similar arrangement here as well?
So the program contours remain same. Okay, the stop supply arrangement will remain as it is, right? Over and above, there will be FLDG also. Because please understand that when we go one tier below to the retailers, that is in the coordination and in agreement with the anchor, the distributor. right, and SG Finserve. So all three will sit on the table and decide, now for this distributor, we need to cover 50 retailers, 100 retailers, right? So the anchor team will also sit along and decide on the basic contours. So the risk on that will not increase basically till the time we are sticking to the anchors which we already have with us, right? Again, as management, we need to be conscious that we don't go for tier 2, tier 3 customers, which we need not, because all our growth targets for next 2-3 years are well covered within the existing anchors what we already have onboarded.
All right. That answers. Thank you.
Thank you, sir. The next question is from the line of Prateek Bagrecha from AU Bank. Please proceed ahead.
Yes. Hi. Am I audible?
Yes, sir, you are.
Yes, sir. Sir, the questions is mostly regarding, the management motivation, which the promoter group keeps. Like, what are the incentives and motivations that you would like to, keep to make sure that, such transitions do not affect and impact the company going ahead?
So definitely, if you have tracked APL Apollo tubes, right, it's all in public domain. The wealth APL Apollo generated for its employees in last 10 years is almost $100 million. And with the same philosophy, all our other ventures within the group, they carry the same philosophy, and with the same philosophy, we incubated and promoted those businesses. And SG Finserve also, we carry same thought process that the employees, the management should be part of the wealth creation, what this business will generate over the years to come.
Okay. And sir, secondly, how would the credit transition happen? So basically, currently the CEO or CFO would be hands-on with a lot of key accounts and their understanding of the credit risk there and the way monitoring is to be done. So basically, how is the, company looking at that, the tracking and monitoring of those particular accounts?
So see, there are two things. One is, any loan which is given, it's not given by an individual. It is given by a committee, right? And in that committee, consisted, the participants were more than the CEO and the CFO, right? There were other participants also which are staying in the company, right? Secondly, as far as the CFO profile is concerned, we are elevating Sanjay, who was already working with Sahil as deputy CFO, although non-designated, but that was the capacity he was working in, right? So there we don't see much of a challenge. And as far as Saurabh's profile is concerned, Saurabh is going to be with us for next 40-50 days, right? And the transition already started almost around 15-20 days ago, right? So we have a good window of 60 days where we would complete all the transition very, very smoothly.
Okay, sure, thanks.
Thank you, sir. The next question is from the line of Aditya Late from Akshara Capital. Please proceed.
Hi, I have just one question. I just wanted to understand any challenges the existing management has faced with SG Finserve and anything you would have done differently while building the business. That is one. And I have one suggestion. I think we should avoid getting into the forecasting game, like when we are saying that we want to forecast at the exact amount for the next quarter or for the next year. I think the guidance for the book is okay because that's a broad guidance. But when we get down to PAT and all, we always end up disappointing. That's just one suggestion. And the query was what I asked earlier. Thank you.
Thank you, Satya. I think whatever we put in place, we're extremely proud the way we've done it, and nothing major that we could have done differently, except you rightly mentioned that forecasting PAT we could have done differently, and I believe the new management coming in would take care of that in future. Thank you.
Thank you, sir. Ladies and gentlemen, this was the last question for today. I would like to hand the conference over to management for closing comments. Thank you, and over to you, sir.
Thank you, everyone. I think the last 3 years have been a lot of learning, a lot of insights, and the way we've built SG Finserve from ground up, we feel proud of that, and wish all the very best to the incoming management. And I'm sure what we have envisioned for the upcoming years for SG Finserve, they will be fulfilling that for all of us. Thank you so much for the support and trust that each one of you has shown all throughout this journey.
Thank you, sir. On behalf of SG Finserve Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.